Welcome to the deep dive. Today we're taking a closer look at a company that, well, it's captivated millions with language learning, hasn't it? But it's also kind of quietly building this impressive educational empire.
That's right. We're talking about Duolingo Inc., trading on the NASDAQ, ticker DUOL.
And here's the really fascinating tension we want to unpack for you today. Duolingo is, by almost every measure, just an exceptionally high-quality, innovative, really well-run business.
Absolutely. But, and this is the big but, its current stock price, well, it presents a pretty compelling challenge for anyone thinking about an investment right now.
Exactly. So our mission in this deep dive is basically to give you a shortcut, to getting well informed about Duolingo.
We'll dig up some maybe surprising facts and offer key insights so you can really grasp what matters in this company's story.
And just for context, all the data, the financials, market sentiment we're discussing, it's all anchored to August 25, 2025. We're using the closing share price from August 19, 2025, which was $338.88.
Got it. And we've structured this into two main parts, haven't we?
We have. Part one is all about laying the foundation. We'll cover Duolingo's business, the management, financial health.
And then, in part two, we'll switch gears. We'll look at market sentiment, who owns the stock, the key risks, and finally pull it all together in our conclusion. Sound good?
Sounds perfect. Let's get started. We begin our exploration with part one, the foundation.
And kicking off part one, we dive straight into chapter one, business analysis.
So, okay, at its core, how does Duolingo actually operate? It's this sophisticated freemium model, right?
That's the heart of it. Their mission is really about making education universally accessible. So they offer most of the content completely free.
Which seems, well, brilliant, frankly, because it attracts this absolutely massive user base and the cost for each additional user is tiny.
Exactly. And that free product, it isn't just marketing fluff, it's a core strategic asset. It fuels what they internally call the green machine.
The green machine, I like that.
Yeah, it's this powerful sort of self-reinforcing loop. User growth leads to data, which improves the product, which attracts more users, and eventually drives profitability. Removing that financial barrier is key.
It really democratizes learning while building this organic growth engine that's just incredibly tough for anyone else to copy.
Precisely. Now, how do they actually make money from this huge base?
Right. The revenue streams. Subscriptions are the big one, usually around 73% of revenue historically. That's things like Super Duolingo, Duolingo Max.
Offering the ad-free experience, offline access, more advanced features, that sort of thing.
And that stream is growing fast, up 46% in Q2 2025 alone.
Which is huge. Then you've got advertising, which monetizes the enormous free user base. Historically, maybe 15% of revenue.
Around that, yeah.
But there's also the Duolingo English Test, the DET. That's becoming a really interesting and profitable stream. It's a one-time fee.
And it's getting wide acceptance, isn't it? Over 5,600 universities globally. Yale, Duke, Columbia.
Right. It's seen as this cost-effective alternative to the traditional, often really expensive English proficiency exams.
And then, of course, the little things, the in-app purchases, like getting a streak freeze, which honestly is genius how it ties into the whole gamified structure. They know how to keep you hooked.
Oh, absolutely. That streak is powerful. Speaking of products, the flagship is, naturally, the language app itself.
World's most popular, offering over 100 courses, 40-plus languages.
Including endangered ones, even fictional ones like High Valyrian from Game of Thrones.
High Valyrian. See, that tells you they're thinking creatively, thinking outside the box.
Definitely. But they're not just sticking to languages anymore, are they?
No, that's a key strategic move. They're expanding into music, math, even chess now, leveraging that same gamification engine they've perfected.
And that significantly broadens their market appeal, right? It underlines just how dominant their position and scale already are.
Since 2012, they've been the leading mobile learning platform, most downloaded language app.
The scale metrics are staggering. As of late 2024, we're talking around 117 million monthly active users, MAUs, and over 40 million daily active users, DAUs.
It's enormous. Put that in perspective. Back in 2021, Duolingo had something like 61% of all downloads among the top 10 language apps.
61%.
Yeah.
Compare that to competitors like Monly at 9%, Babbel 7%, Busuu 6%. They're just dwarfed.
Totally dwarfed. So what's the core appeal, the primary value proposition?
It's simple but incredibly effective, making learning fun, free, and accessible. Anywhere for anyone.
It comes down to that gamification, doesn't it? Earning points, unlocking levels, leaderboards, and that obsessive focus on maintaining your streak.
It fosters motivation, builds that daily habit, and the bite-sized lessons are key too.
Yeah, perfect for modern life. You can do one in just a few minutes.
And that core accessibility, the robust free version, it just removes the financial barrier. It truly democratizes education globally. It's not just talk. They live that mission.
Okay, let's zoom out a bit and look at the industry analysis. The market trends look pretty favorable, right?
Oh, incredibly so. The whole edtech market is projected for explosive growth. We're talking maybe $250 billion in 2025, growing to over $770 billion by 2033.
Wow, that's a compound annual growth rate, a CAGR of over 17%. What's driving that?
Mobile learning, AI integration, gamification, all things Duolingo excels at, plus just increased global connectivity.
And the online language learning segment specifically.
Also strong growth, expected to more than double, maybe $25.5 billion in 2025 to over $54 billion by 2030. That's nearly a 17% CAGR itself.
Driven by globalization, the need for multilingual professionals, the wind is definitely at their backs here.
Absolutely. Now, the competitive landscape includes names you might know: Babbel, Rosetta Stone, Busuu, Memrise.
But Duolingo has this unique position, doesn't it?
It really does. What's fascinating, and tells you a lot, is that people using competing apps often also use Duolingo. It's like a supplement, or even the preferred tool for many.
But the reverse isn't true.
Much less so. Duolingo users show remarkable loyalty. They tend to stick with Duo and rarely use other apps. That's incredibly high product stickiness.
That's a huge advantage right there. What about regulations? Any major hurdles?
Well, they operate under the usual data privacy laws. GDPR in Europe, COPIA for kids under 13 in the US, FERPA for their schools program.
The main risk there is?
Stricter regulations could raise compliance costs, maybe constrain their ability to use data for innovation, which is, a key part of their edge.
Right. Which brings us to barriers to entry. How hard is it for someone new to compete?
It's very hard. The hurdles are significant. First, just brand recognition and scale. Duolingo is practically a household name in this space.
And then the tech advantage.
That's the big one. Their technological and data moat is almost impossible to replicate quickly. They have over a decade of data from billions of exercises completed.
Fueling their own AI system.
Exactly. It creates this compounding advantage. The more people use it, the smarter it gets, the better the experience, the more people use it.
And don't forget the switching costs. That Skreek feature. It's psychological warfare almost.
It really is. People get so invested in a long streak, hundreds, even thousands of days. They really don't want to break it to switch apps. It's a powerful hook.
So all these factors combined create Duolingo's competitive advantage, their moat, right?
Precisely. You've got the brand strength, helped by Duo the Owl and that kind of unhinged but effective social media presence.
Which drives massive organic user acquisition. Their marketing costs are relatively low.
Leading to huge cost advantages and economies of scale. Very low customer acquisition cost, CAC. And as a software platform, high operating leverage as fixed costs spread out.
Plus, the network affects more users, smarter AI.
And those switching costs from the streaks we mentioned. And their unique asset, that colossal pool of user learning data.
It's the lifeblood of their AI, allowing hundreds of A/B tests, constantly optimizing the experience. It just keeps compounding.
It really does. It's an incredibly well-designed system.
Okay, let's shift gears. Next up, Chapter 2, Management Evaluation.
Right. A key point here is that Duolingo is founder-led.
CEO Luce Van An, the CAPTCHA inventor, and CTO Severin Hacker, both with deep tech backgrounds from Carnegie Mellon.
That technical expertise at the top is pretty foundational to their product-driven approach.
How have they handled challenges? There was that controversy in spring 2025 about the AI first memo replacing some human contractors.
Right, there was backlash, but management did acknowledge it as a communication misstep on the earnings call. They adjusted their social media strategy. It showed at least a willingness to listen and adapt.
What about communication generally and ethics?
They seem to maintain a high standard, especially with investors. Comprehensive IR website. They even won awards for it in March 2025.
And the ethical reputation seems tied to that mission of free access.
Definitely. That contributes a lot to their positive public image and helps drive that organic growth we talked about.
Now, capital allocation, how do they use their money?
Very disciplined. The focus is overwhelmingly on reinvesting in R&D, improving the product, user engagement, retention, not big flashy marketing spends.
And their M&A strategy, acquisitions.
Smart and targeted. They do small, strategic acqui-hires, buying talented teams, not massive companies. Think Gunnar and Hobbs for animation, NextBeat for music gaming, That was about $34.5 million.
So acquiring specific talent and tech to bolster the product, avoiding those big, risky integration headaches.
Exactly. It speaks to that disciplined leadership. And related to that, no share buybacks, no dividends.
Which is totally appropriate for a high-growth company like this, right? They should be reinvesting earnings.
Absolutely. And you see the results in their return on invested capital, or ROIC. The trend is fantastic.
It turned positive and is accelerating fast.
Yeah, from around 7.5% up to over 22%. It's starting to really outperform the industry average, which is below 10%. That's a hallmark of a compounding machine starting to hit its stride.
Very encouraging sign. Okay, let's move on to the numbers themselves. Chapter 3, Financial Analysis.
All right, let's run through some key metrics. Market cap is around $15.5 billion, so it's a large cap stock.
And the revenue growth, you mentioned it earlier.
It's been, frankly, stunning. Hypergrowth, from about $70 million back in 2019 to nearly $750 million in 2024. That's a TIGR over 60%.
Wow, and it's still strong.
Still very strong. Trailing 12 months, or TTM, revenue is over $885 million. That's still up almost 40% year over year. Incredible momentum.
What about profitability? Margins.
This is where you really see the operating leverage kick in. Gross margin is consistently high, stable around 72–73%. That's typical for software.
But the operating margin, that's the big story.
Huge swing, from negative 24% back in 2021 to a positive 9.7% for the TTM ending Q2 2025. Shows incredible scalability.
And net margin followed suit?
Yep. Also turned positive, from negative 24% in 2021 to over 13% TTM. The business model is clearly proving it can scale profitably.
And free cash flow.
Exceptional generation. It was negative in 2019, but now it's surged to over $320 million TPM. It's just churning out cash now.
It's financially stable.
Very much so. First full year of GAAP profit was 2023, $16 average, jumped to nearly $89 in 2024. Debt to equity is super conservative, below 0.6. Loads of flexibility.
Current ratio strong too.
Exceptionally strong at 2.81. Plenty of short-term liquidity. And again, no dividend. They're reinvesting everything.
Okay, now for the crucial part. Valuation analysis. This is where that tension comes back.
That's the crux of the bear case, yes. The TTM price to earnings, or PE ratio, is, well, it's sky high, somewhere between 127 and 152.
Which is massively higher than the average stock, reflecting huge growth expectations already baked in. Hard to compare to peers, too, since many aren't profitable.
Exactly. So relative valuation like PE isn't that helpful here. We need to think about intrinsic value. That often means using a discounted cash flow, or DCF, analysis.
Right. Explain that quickly. You forecast future free cash flows and discount them back to today's value.
That's the idea. It tries to estimate what the business itself is fundamentally worth, based on the cash it's expected to generate over its lifetime. Long-term investors really favor this approach.
Okay, so what does an educational DCF model suggest for Duolingo's intrinsic value?
Well, running the numbers suggests a value of approximately $166.70 per share. Some other analyses point even lower, maybe around $110.
167. Compared to the market price we noted of $338.88. That's a huge difference.
That's a massive disconnect. More than 50% potential overvaluation suggested by this kind of analysis.
So for our listeners, it's like saying you found this absolutely fantastic best-in-class car, but while a careful analysis suggests it's worth maybe $30,000 based on its parts and performance, the dealer's asking $60,000 for it. Great car, terrible price.
That's a good analogy. Now, DCFs rely on assumptions, of course.
What are the key ones here?
This model assumed revenue growth slows down from 25% to a more mature 7% over 5 years, then a 4% terminal rate. It assumes operating margins expand nicely to 22%. And it uses a discount rate, the WACC, of about 7.34%.
So solid assumptions, but even with those, the value comes out way below the current price. It implies the market is pricing in perfection, or even better, for many, many years.
That's certainly what it suggests. A lot of future success is already reflected in that $339 share price.
Okay, quite a foundation laid. Let's move into part 2. Market, ownership, risk, and conclusion.
Kicking off part 2, we have chapter 4, market sentiment.
So what's the general feeling about Duolingo out there? Wall Street analysts seem pretty positive.
Largely, yes. The consensus rating is generally moderate buy to strong buy. Average 12-month price targets are up there, ranging from maybe $451 to $497.
Suggesting significant upside from the current $339 level, according to them.
According to them, yes. But the general media tone is a bit more mixed.
How so?
Financial press loves the strong earnings, the user growth, new features. But you also had that critical narrative emerge from the AI-first memo thing back in the spring. That generated social media backlash.
Right, the reputational angle. What about market indicators? Short interest.
It's notable. Somewhere between 5.3% and 6.9% of the float is sold short. That's higher than the average peer group, which is more like 4.2, 4.4%.
Suggesting a decent chunk of the market is betting against the stock, likely because of that high valuation we keep coming back to.
That would be the logical reason, yes. And technically, the price action isn't great lately.
Below its 50-day moving average.
Significantly below. The price around $339 versus a 50-day SMA, somewhere between $392 and $407. That signals a clear short-term downtrend. Momentum has shifted downwards.
And the longer-term picture, the 200-day moving average.
The stock actually crossed below its 200-day SMA back in July 2025, and it stayed below it. Price is $339 versus a 200-day somewhere between $373 and $392.
Which is often seen as a more bearish long-term signal, right? Suggests the major uptrend might have stalled or reversed.
That's the typical interpretation, yes. The technical picture currently looks weak.
Okay, let's look at who owns the stock. My next segment is Chapter 5, Ownership Structure.
Institutional investors really dominate here. They hold the vast majority, somewhere between 85% and almost 92% of the shares available for trading. The float.
Names?
Yeah, the usual suspects. BlackRock, Vanguard, Fidelity, FMR LLC, Capital World Investors, Bailey Gifford. This provides some stability, but if one of those giants changes their mind, it can move the stock significantly.
What about insiders, founders, executives?
They still own a substantial chunk, around 14%, nearly 16% of the company. That usually means good alignment with shareholders' interests.
But there's a but here too, isn't there?
There is, and it's a potential red flag. There has been significant and consistent selling by insiders over the last 12 months.
Selling, like planned sales or...
Regular open market sales. For example, the CTO, Severin Hacker, sold over $3.6 million worth just in July and August 2025. The CFO, Matthew Skarupa, is also a regular seller.
And crucially, any insider buying.
Absolutely none recorded on the open market. Zero.
Tell. The people who know the company best are consistently selling shares at these prices, and none of them are stepping up to buy, even with their large existing stakes.
It certainly suggests they might not see the current price as a screaming bargain, despite the company's quality.
And tying this to control, they have that dual-class share structure, right?
Yes. Class A shares get 1 vote, Class B get 20 votes.
And the Class B, held by founders and early investors, controls.
At the time of the IPO, it was around 98% of the total voting power. So management has full control. They're pretty much insulated from activist investors or hostile takeovers.
Okay, makes sense. Now let's broaden the view again. Chapter 6, Risk Assessment.
A SWOT analysis is a good way to frame this. Strengths, weaknesses, opportunities, threats.
Let's start with strengths. We've covered many. Dominant brand, super engaging product, effective freemium model.
Vast data asset, AI expertise, strong founder-led management. These are major internal competencies.
Okay, weaknesses.
Number 1 has to be that extremely high valuation we've hammered home. Also, maybe limited depth for really advanced language learners currently. And like any app, dependence on Apple and Google's app stores. Platform risk.
Makes sense. Opportunities, where can they grow?
Lots of places. That expansion into new subjects, math, music, chess is huge. International growth, especially teaching English in Asia. Deeper AI integration, maybe AI conversation partners, and just better monetization, like with Duolingo Max or family plans.
Plenty of runway there. And finally, threats. External challenges.
Intense competition, especially as they move into new areas like music or math, where other players exist. Technological disruption is always a threat. What if real-time translation tech gets really good?
Good point. Shifting consumer preferences, too. Maybe toward live tutoring or VR learning.
Could be. And as we saw with the AI memo, reputational risk is always present. One wrong move can damage that positive brand image.
What about bigger picture macro factors? Inflation.
It's a double-edged sword. Inflation can hurt disposable income, maybe impact subscriptions. But Duolingo's low price point, especially the free tier, might make it more attractive if people are cutting back on expensive alternatives. Kind of a defensive quality.
Interesting. And interest rates.
That's generally a headwind for high-growth, high-multiple tech stocks like Duolingo. Higher rates mean future cash flows are discounted more heavily, putting pressure on the valuation.
But operationally?
They're pretty insulated.
Yeah.
Very low debt, lots of cash. Higher rates actually mean they earn more interest income on that cash balance.
Okay. Any specific geopolitical factors, those U.S. tariffs from 2025?
Negligible direct impact. It's software delivered electronically, not physical goods. Maybe a tiny indirect hit on cloud costs, but likely not material.
Other geopolitical risks. China. Data laws.
Yeah, operating globally brings complexity. Data localization laws can add costs. And market access in sensitive regions like China could face restrictions or censorship demands given the educational nature of the product.
Right, always factors to consider for a global platform. Okay, let's bring it all home. Our final segment, Chapter 7, Conclusion.
So let's synthesize everything we've discussed. The bull case for Duolingo is, honestly, incredibly strong.
Market leader, durable moat brand, network effects, switching costs, that unique data AI advantage.
Founder-led, disciplined capital allocation, explosive growth, high margins, accelerating free cash flow, significant future opportunities. It ticks a lot of boxes for fantastic business.
It really does. But then there's the bear case.
And it really hinges primarily on one thing: valuation. The stock just trades at a very, very high PE multiple.
Suggesting years and years of future growth are already priced in today, very little margin of safety.
Exactly. And that's strongly supported by the intrinsic valuation models like the DCF we talked about.
And reinforced by that pattern of consistent insider selling with zero buying.
Plus the recent negative price momentum shown by the technical indicators.
So just to recap the valuation summary, our educational DCF model points to an intrinsic value around $167 per share.
Right. So what's the concluding outlook?
Yeah.
You compare that $167 estimate to the market price of $338.88 back on August 19th.
The gap is huge.
It is. Duolingo is, without a shadow of a doubt, an exceptionally high-quality business. It's almost a textbook example of the kind of company a long-term investor should want to own.
Want to own, yes, but the price you pay matters enormously.
That's the key takeaway. The current stock price, at more than double that estimated intrinsic value, just doesn't seem like a wonderful price.
The risk of your capital decreasing just because the multiple compresses seems pretty high from these levels, potentially outweighing the prospect of further gains driven by business growth alone.
That's how it looks based on this analysis. The price seems disconnected from the underlying fundamentals today.
Which leaves us with a provocative thought for you, the listener. How much of Duolingo's undeniably bright future potential is already factored into today's stock price? And what does this whole case study teach us about that critical balancing act between identifying a truly great business and paying a sensible price for it?
Something definitely worth mulling over.
Indeed. Well, thank you for joining us on this deep dive into Duolingo. We really hope you're leaving feeling well-informed and maybe with some surprising new insights.
And remember, you can like and subscribe to the Stock Analytics AI YouTube channel for more deep dives just like this one.
That's right. And members, you can add stock suggestions for future videos right there in the comments. We do pick them up. For just $4.99 a month, members get priority deep dives on tickers.
And we've got a big project coming up over the next few months. We're covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives.
Don't miss out on that. And if you just want a one-off deep dive on a specific company, you can always drop us a super thanks.
And finally, the important disclaimer. Please remember, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice.
Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.